A lot of investors tell you either have to invest in growth or in income, but why not choose both? In this video, I'm explaining why I chose to invest in QQQ and DIVO inside the joint account. Let's head over to the research. So why did I choose QQQ to be half of the joint account portfolio? Well, QQQ's been around for a very long time, since 1999, and it's had fantastic performance, up 618% in the last 10 years. It has 102 holdings, most of them you'll probably recognize, like Nvidia, Apple, Microsoft, AMD, Google, Tesla, you get the picture. But it also holds things like Walmart and Costco and Pepsi. So you're going to get a little bit of buffer from pure technology. If we scroll down to the sectors, you can see that it's 67% technology, but there's also some consumer discretionary and some telecommunications, and a little bit of healthcare, industrials, yada yada. You get the picture. So it's not just pure tech, which I actually really like. It also has a low expense ratio, 0.18%. That's really low. The other great thing about investing in an ETF like QQQ is it rebalances quarterly. So the share or the percentage of those stocks inside of the ETF are going to grow if the market capitalization is growing. So the stocks are growing, they're going to get a larger percent. Inversely, if they're poor performing and they're taking less market capitalization, then the share percentage inside the ETF is going to shrink. So you're always going to be holding more of the top performers. It also reconstitutes, so the low performers will be cut out and the higher performers will be added into the ETF. So why did I choose to invest in DIVO in conjunction with QQQ? Well, DIVO is a lot more defensive. It's not growth tech focused. It is focused on a basket of blue chip stocks that pay dividends, and it also provides a lot more income and stability. And that's the main reason. We need some balance to the portfolio. QQQ has a lot of drawdown. So if there's a bad year for tech, your portfolio is going to get absolutely hammered. If you pair it with a defensive position like DIVO or SCHD, that will help the drawdown significantly, and you can ride out the wave and continue to invest. If you go down to the total return here, we're at 12.61% annualized, which is great. It's not as good as the S&P 500 though. But if you pair something like DIVO with QQQ, you're going to get something that has a higher return than the S&P 500 with less drawdown. The holdings here are companies you'll recognize, like Caterpillar, Apple, Chase, Goldman Sachs, Microsoft, American Express. Very different from QQQ. You're going to see Apple and Microsoft. Those two are the same, but in general, they're going to be different holdings. Financials. Financials are going to be the top holding here. There's no financials in QQQ or most other tech funds, so you're going to get that weighting here. So that's also going to add a little bit of diversification to your portfolio. Moving on to the distributions and yield. It pays monthly, so you're going to get about 18 cents per share per month. So whatever you've owned, you have 20 shares, times that by 18, that's the amount of money that's going to get deposited into your brokerage account. You can choose to spend that money on whatever, or you can choose to reinvest it back into your own portfolio or back into DIVO. It pays about 6.4%. I know it says 4.78 here, but I did some more research. If we go over here, it pays 6.43%. So that's a really good yield, more than what you're going to find from the S&P 500 or the Dow Jones Index or any of the major indexes. The things I want to flag is the way that they generate this much income. Well, two ways: dividends, so these stocks pay dividends, but also the fund manager will be writing covered calls. I'll make a video on covered calls for everybody to watch, but the main risk is that it can cap your upside growth. So that is a risk, but I'm going to stick to the facts. It has a 12.61% annualized return, and that's just the way it is. So they've been doing this right for 10 years, and it fits my risk profile. This is the strategy that I want to have in my portfolio. And the final thing I wanted to flag as a risk is the total expense ratio. 0.56 is high. Another thing that I always like to check before investing in multiple ETFs inside the same account is to make sure their overlap is fairly minimal. You don't want to be investing in two ETFs that are almost exactly the same. Then you might as well just invest in one. But these two ETFs are very different. Only 14% by weight is the same between the two. Technology, of course, on QQQ is going to have a much higher weighting, and financials in DIVO, including industrials and energy, also have a larger percentage. You can also scroll down here and see what shares, or not what shares, what companies themselves are the same between each ETF. So you can see that Apple, Microsoft, Walmart, Nvidia, and Amgen are also in QQQ and DIVO. All right, now it's time to backtest. It's always a good idea to backtest different combinations of ETFs and stocks before you invest in them. I already set this up to have 50% in QQQ and 50% in DIVO, and that's getting compared against the benchmark ticker SPY. So that's the S&P 500. This will look back till 2017, and it will show you how you performed in that period with this certain portfolio setup. So right off the bat, the sample portfolio is our combo. And if you started with 10,000, you'd end with 47,749. Compare that to the S&P 500 at 39,225. That's a big increase. The annualized return is 18% versus the S&P 500's 15.62. The worst year, I believe, is, there it is, 17%, negative 17% versus negative 18%. And the maximum drawdown is about 1% or so less. So you're getting less drawdown and a lot more return. And the Sortino ratio is risk adjusted return. So basically how much risk you're taking, how much return you're going to get. So the higher the ratio, the better. And we're at a 1.72 with the combo and a 1.34 with the S&P 500. And you can go down here and you can see the chart throughout the years. So starting in January, it's just taking off. If you're looking for two ETFs that pair together well, that offer high return, lower drawdowns, lower volatility, and dividend income, DIVO and QQQ might be the right pair for you. But as always, personal finance is personal. Do your own due diligence, stay growing, stay happy, and I'll see you in the next video.